The income statement is a vital financial document that provides detailed insights into a company's revenues, expenses, and profitability over a specific period. It serves as a key tool for internal decision-making and external analysis, offering stakeholders a clear view of the company's operational efficiency and financial health. Despite its limitations, when used in conjunction with other financial statements like the balance sheet and cash flow statement, the income statement is indispensable for understanding a company's financial position and performance. Below is a good overview for income statement. 1. Purpose of the income statement. The income statement's purpose extends beyond merely showing profit or loss. It is an essential tool for analyzing the performance of a business over a specific period. The statement allows management and stakeholders to evaluate profitability. By comparing revenues to expenses, the income statement provides a direct measure of how much profit the company is generating from its core business activities. Understand revenue streams. It helps in identifying which products, services, or divisions are the most profitable, guiding strategic decisions about where to focus resources. Expense management. By breaking down expenses, the income statement highlights areas where the company may be overspending, providing opportunities to improve efficiency. Predict future performance. Analyzing past income statements allows for forecasting future earnings, which is vital for budgeting and financial planning. 2. Structure of the income statement. A. Revenue, sales. Gross revenue. This is the total income generated by the company from all its business activities before any deductions. Gross revenue includes income from the sale of goods, services rendered, and other sources like interest, royalties, or fees. Net revenue. After accounting for returns, discounts, and allowances, the net revenue represents the actual amount of money the company expects to receive. Net revenue provides a more accurate reflection of the company's true earning power. Returns. Products returned by customers. Discounts. Price reductions offered to customers. Allowances. Price reductions for damaged goods or other issues. B. Cost of goods sold, COGS. COGS components includes direct costs like raw materials, direct labor, wages of workers directly involved in production, and manufacturing overhead, indirect costs like utilities and rent for the production facility. For retailers, COGS includes the cost of purchasing inventory. For manufacturers, COGS includes the cost of producing goods, which encompasses materials, labor, and manufacturing overhead. For service providers, COGS might include labor costs directly associated with providing the service. Impact on gross profit. Gross profit is derived by subtracting COGS from net revenue. A higher COGS reduces gross profit, signaling either rising costs or inefficiencies in production. C. Operating expenses. Operating expenses are categorized into several types, each playing a significant role in the company's day-to-day functions. Selling, general, and administrative expenses, SG&A. Selling expenses, costs directly tied to selling the company's products or services, such as advertising, sales commissions, and distribution costs. General expenses, overhead costs not directly tied to production, such as office rent, utilities, and administrative staff salaries. Administrative expenses, costs associated with the management and general operation of the company, including executive salaries, legal fees, and accounting services. Research and development, R&D, expenses, costs incurred in the development of new products or services. R&D is crucial for companies in technology, pharmaceuticals, and other innovation-driven industries. Depreciation and amortization. These are non-cash expenses that allocate the cost of tangible and intangible assets over their useful lives. Depreciation applies to tangible assets like machinery, vehicles, and buildings. Amortization applies to intangible assets like patents, trademarks, and goodwill. D. Operating income, Operating profit. Operating income calculation. Operating income is calculated as gross profit minus operating expenses. It reflects the profitability of the company's core operations without considering the effects of financing or investments. Importance. Operating income is a critical measure because it indicates how efficiently a company is running its core business. A company with high operating income is generally considered to be managing its resources well. Non-operating items. Other income/expenses. These include revenues and costs not directly related to the main business activities. Common examples include interest income, earnings from investments or savings accounts. Interest expense, costs associated with borrowing, such as interest on loans or bonds. Gains or losses on asset sales, profit or loss from selling company assets like equipment or real estate. Unusual or infrequent items. Sometimes, the income statement includes unusual or infrequent items, such as a gain from the sale of a subsidiary or expenses related to a natural disaster. These items are often reported separately to provide a clearer picture of ongoing operations. Earnings before tax, EBT. EBT is the income before taxes are deducted, reflecting the company's profitability after accounting for all operating and non-operating income and expenses. Income tax expense. Taxable income, the income on which the company's taxes are based, usually derived from EBT after adjustments for tax purposes. Income tax calculation. The tax expense is calculated based on the applicable tax rate and can be influenced by tax credits, deductions, and other tax-related items. Deferred taxes. Sometimes, there are differences between the tax expense reported on the income statement and the taxes paid, leading to deferred tax assets or liabilities. Net income. Net income calculation. Net income is the final figure on the income statement, calculated by subtracting income tax expenses from EBT. It is the amount of profit or loss that remains after all expenses have been deducted from total revenues. Indicator of overall profitability. Net income is a crucial metric for assessing the company's overall financial performance. Positive net income indicates profitability, while a negative net income, net loss, indicates that the company spent more than it earned. Impacts on dividends. For shareholders, net income is particularly important as it often determines the dividends paid out. Companies typically distribute a portion of net income as dividends to shareholders. 3. Importance of the income statement. Internal analysis. Management uses the income statement for internal analysis to make operational and strategic decisions, such as whether to expand, cut costs, or invest in new projects. External analysis. Investors and analysts rely on the income statement to assess a company's financial health, compare it with industry peers, and make informed investment decisions. Regulatory requirements. Publicly traded companies are required by law to prepare and publish income statements, ensuring transparency and accountability to shareholders and regulatory bodies. 4. Common metrics derived from the income statement. Gross margin, calculated as gross profit divided by net revenue. This metric shows the percentage of revenue that exceeds the cost of goods sold. A high gross margin indicates that the company retains a large portion of sales after covering production costs, which can be used to cover operating expenses and generate profit. Operating margin, operating income divided by net revenue. This metric indicates the percentage of revenue left after covering both COGS and operating expenses. A higher operating margin suggests more efficient management of operating expenses. Net profit margin, net income divided by net revenue. This metric reflects the percentage of revenue that ultimately turns into profit. It's a comprehensive measure of profitability, considering all expenses. Earnings per share, EPS. Net income divided by the number of outstanding shares. EPS indicates the portion of a company's profit allocated to each share of stock, and it's a key indicator of a company's profitability on a per-share basis. 5. Variations of the income statement. Single-step income statement. This format groups all revenues and all expenses together, subtracting total expenses from total revenues to determine net income. It's straightforward and easy to understand, but provides less detailed information. Multi-step income statement. This format is more detailed and breaks down revenues and expenses into multiple categories, such as gross profit, operating income, and net income. It provides a clearer view of a company's financial performance by highlighting core operational results separately from other activities. 6. Limitations of the income statement. Non-cash items. The inclusion of non-cash items like depreciation can distort the picture of a company's cash flow. While these items affect profitability, they don't directly impact cash, making it important to consider the income statement in conjunction with the cash flow statement. Subjectivity and estimates. Certain items on the income statement, such as bad debt provisions or depreciation methods, involve estimates that can vary based on management's judgment. This subjectivity can affect the comparability of income statements between companies. Doesn't reflect cash flow. While the income statement shows profitability, it doesn't provide a direct view of cash flow. A company may be profitable on paper, but still face liquidity issues if it doesn't have enough cash to meet its obligations. Therefore, it's essential to analyze the income statement alongside the cash flow statement to get a complete picture of financial health.